Welcome to Opales TV. Today I'm in Paris, in the office of Parcel Capital. I have with me today Jean-Louis Juchault. He has been in the industry for many decades and in 2011 set up Parcel Capital, and his portfolio manager Xavier Robinson. So I thought, Jean-Louis, please give us a big rundown of your career and the different stations, and also what was your rationale to set up Parcel Capital.
Thank you for visiting Puzzle. I've been in the industry, as you said, for a few years. I was managing Barrep during the 90s, so it was a 5 billion AUM company, multi-strat hedge fund, a subsidiary of SocGen. Then I created Sistea Capital Management with my colleague David Obert. We managed $1.8 billion at the top, and it was a multi-strat, just the same hedge fund company. We sold it in May 2008, so we were the lucky people at the time. Took some time off and then started Puzzle Capital with David Obert again. Puzzle is more of a family office for us now, but we met with Xavier Robinson and we decided to jump back into the hedge fund arena, because we thought that first, Xavier is an excellent manager, so the opportunity was fantastic. And second, the merger arbitrage universe is extremely attractive too. There is a fantastic market timing for entering this market now, and actually the performance show that quite well.
So Xavier, you have been in the merger and acquisition space for 20 years now. Please tell us also more about your background.
I started my career in 1995 with BNP Arbitrage, where we were investing into North American merger arbitrage situations. I did that for 2 years, and then in order to better understand the risk associated with the merger arb situation, I went into M&A advisory investment banking, where I joined Lehman Brothers in London in 1997, and then I joined Salomon Brothers in 1998, which became Citigroup, and I worked in the TMT advisory team. I did that for 9 years, advising on large M&A transactions. And then in 2006, I went back to the buy-side industry, joining Dexia Asset Management, where I was part of the management team of Dexia's both strategic funds in merger arb. And in 2010, I met with Juchault and David Obert, and we started the fund Abrax, which we launched in 2011.
So tell us more about your specific style of doing merger arb now with the Abrax fund.
Our investment style is quite simple actually. We invest exclusively in very safe transaction. The most important part in merger arb is to avoid deal breaks. Basically, when you have a deal break, it takes you 10 deals to make it back. We try to avoid deal breaks, and by investing only in very safe deals and late stage transactions. This is the most important part. We invest only into definitive merger agreement transactions, friendly deals, and we size and calibrate the position according to their timing to completions and the conditions left in the deal. We are quite selective in our approach. We invest in approximately 120 transactions per year. We have invested in approximately 600 transactions in 5 years, and today, so far, we have had one deal break over 5 years, which was the Shire AV transaction in October 2014.
So yeah, that's a really important point, that avoiding deal breaks really saves you performance, and you have been successfully doing that. Can you give us examples of trades where you've seen everybody else piling in but you had stayed out, and also give us the reason why you stayed out?
Well, we stayed out of those deals just because by principle of precaution, because those transactions, were quite speculative. The last one in mind was Milan acquiring Perrigo. It was the hostile transaction, which was obviously not recommended by the board of Perrigo. The threshold was quite low at 50%. Having said that, it was still a speculative deal, and we decided not to enter into this transaction. We only do friendly transactions which are recommended by both the board of directors and the key shareholders. Otherwise, we would not invest in the deal. Another example, for instance, is the Zurich and acquiring the RSA insurance in London. We avoided this deal because even if it was a friendly situation, there was no contract in place. There was no definitive merger agreement between the both companies. Therefore, something happened in quite unexpected in Asia, which impacted quite significantly Zurich Insurance, which in the end decided not to pursue the deal anymore. This is how we avoided it, because if there was a contract in place, Zurich Insurance would have not been able to walk away from this transaction.
Xavier's point is extremely important because in the merger of business, you know how much you could make on each trade. The big issue is not to lose money on a breaking trade. And Xavier has been extremely good at avoiding bad trades. One interesting example is the TNT UPS trade that happened a few years ago, 2 years ago. Everybody thought that this trade was attractive, but the analysis that we conducted showed that there were a lot of antitrust issues that were still pending. So we avoided entering into that trade and we avoided losing a lot of money.
Okay, you obviously do a very good job in protecting capital and not losing money, but I can see from your track record you're also making money. So performance has been very good, extraordinarily good. Tell us more about how you actually achieve those returns.
We have a very disciplined approach when it comes to investment. As I mentioned at the very beginning, we make sure we invest only into very friendly deals and into late-stage transactions. But we also apply a very thorough filtering process, which is based on my 10 years of investment into merger arb, more looking at quantitative criteria which are very, very specific, and avoiding outliers which potentially could lead to a deal break. And then on top of that, I apply a qualitative filter which is based on my 10 years experience in investment banking advisory by going through all legal documents around an M&A situation. This is key. It avoids, multiple of obviously deal break, but it also enables me to spot on and identify interesting transaction. A very good actually situation occurred this year, which was post following the Shire AV deal break in October 2014. Spreads have widened because the risk aversion is greater today. And also, not only you see a general widening of the spreads, but also you see some dispersion across the spreads. And sometimes it is completely unjustified. We've seen a lot of situations whereby there's been a lot of scare on some spreads, which was completely unjustified, on which we extracted a lot of alpha. I can quote several spreads, such as Altera being acquired by Intel. That spread was extremely attractive for us, where the market saw that this deal could potentially be blocked by the US FTC. It ultimately got approved from both the US angle as well as the European angle. The same situation happened on Orbit being acquired by Expedia back in September. There was a lot of nervousness around those spreads. Following, post the Shire AV transaction, which collapsed a year ago, and we still see the consequences of this today. So that has created a very favorable environment for our strategy. When I'm talking about those two transactions, I mean that there have been very attractive pricing inefficiencies into the spreads. One example was Orbit, therefore, that I was mentioning. Just prior to the US FTC approval, the spread was 6% flat prior to the FTC approval. That deal got the approval and then closed the following day. So basically, we managed to make 6% in one day. So this is a kind of example where you have really an asymmetry of not information, but perception between the market and the reality of the transaction. And the same situation, approximately the same situation, happened on Altera being acquired by Intel, where the spread was approximately 8% flat just prior to receiving the HSR approval and subsequently the European approval. Therefore, we managed to make 6% flat out of this 8% spread just on those two approvals in less than a month.
So that was very interesting. I see in your track record you had a fantastic October 2015. What happened there?
Actually, yes, this year is a very positive year for us. We're up 21% on a year-to-date basis. We made a very strong month in October 2015, but we actually didn't make our year in October 2015, we made it in August. In August of 2015, this is where we really managed to crystallize our year. There was a lot of market nervousness and volatility in Asia, which subsequently and later had an impact in the European and American market. On August 24, the Dow Jones went down 1,000 points in 30 minutes. There was a lot of market nervousness. We take this opportunity as an investment trigger for our strategy, and we managed to lock up spread at very attractive level. Therefore, embedded invested P&L to come doubled that day. Those spreads eventually crystallized in October, and this is how we managed to produce a 7.5% return in October. And also, just to mention that performance of October of 7.5% was obviously not done on one particular situation, but across 7 different spreads, which all got their key approval during that month.
So we talked about some of your best months. Let's look at some of your worst months. What happened there and what were the consequences of that?
We have had quite a strong volatility episode in October 2012, where we had several positions that became corrected because they were bound by the same political decision in Canada in the energy space. One transaction was Progress being acquired by Petronas, and the other situation was Nexen being acquired by the Chinese state-owned entity CNOOC. Those decisions took more time than expected to close. Therefore, it created significant volatility not only on our portfolio but also in the market overall, which triggered a general widening of all merger spreads. So we had an important loss in October 2012, which was spread across 6 different spreads. Our largest loss that month was 3.5% approximately of the NAV. We subsequently made it all back in December when those 2 transactions have been approved by the government of Canada.
So in your fund you have achieved a double-digit compound annual return with no down year. So that's really impressive by any means. So tell me more about your actual skills and the procedures that you think are relevant for this result.
Given my background, I have 3 skills that are key in order to invest into merger arb investment. I've been a prop trader for 2.5 years. That gives me very strong trading skills. I've been a portfolio manager for 7 years. That has given me some portfolio management and structuring skills, which are also extremely important into merger arb, especially when it comes to sizing the transaction and the overall portfolio. And more important, I've been in investment banking for 9 years, and I can spot on immediately the deals that can potentially present a risky situation or not.
Actually, Xavier's skills in identifying the good deals are clearly demonstrated by his track record. We had 1 deal break out of 600 deals that we worked on. So it's a fantastic personal track record. Then we could add that the performance of a fund is not only a one-man show. Obviously, there is a team working with Xavier. There are strong procedures that have been implemented by the company, by Puzzle Capital. There is a independent risk department that reports to the managing directors of the company and gives support to Xavier in identifying where there are some risk zones in his portfolio. There is a strong set of procedures under the AFM regulation. So clearly we were able to add to the extraordinary performance of Xavier a strong setup that enabled the fund to be solid, strong, and that could last over time. On top of that, we obviously work with the best service providers in the industry. As an example, prime broker is Goldman Sachs, which is for a fund in merger arb something extremely important. It gives us the best leverage and the best access to the market. It gives us the best visibility, and it was extremely important for us to be selected by Goldman Sachs when we launched the fund initially.
So I would guess that you're also careful about your capacity. You say you're now still, let's say, a small fund with 65 million, but I would guess there's still room for growth. But would you also cap it, and if so, at what point?
Actually, following this excellent year, we had strong increase in our assets, and many investors are closely looking at the fund today, so there is an excellent market timing. But you're right, obviously we will have to cap the fund sooner or later due to the very specific trading approach that Xavier developed. We will probably be top-ish around 500 million. So today we're 65, so there's still room, but obviously this is not something that could grow to billions.
So we're now at the end of 2015. What's your outlook for the strategy going forward?
Well, no need to say that 2015 has been an exceptional year in terms of M&A volume. We have reached approximately $4 trillion of M&A volume this year, which is almost at the peak of 2007. Having said that, there are still very strong M&A activity going on. Not so long ago, we had a $150 billion transaction between Pfizer and Allergan. There is a lot of deals, M&A in the pipe, a lot of consolidation still happening. CEOs are ready to embark into significant and large M&A scale transaction, which clearly show that they have a strong view of the macro outlook. Therefore, we believe that 2016 and onwards, the M&A market will keep to its current pace, that there will be a lot of deals going on, which will give us not only opportunity to diversify in terms of number of transactions, but also the size of the transaction given enough depth into the market. Having said that, on top of it, as I said, there is a very interesting opportunity, which is a post-Shire transaction, which has given greater risk aversion, and therefore the spreads are wider today, which is a very good opportunity for us. I think that the sector which are going to go and continue to go under consolidation will include telecom and media, healthcare and biotech, and also probably the oil sector, given the depreciated price of oil, but there will be more a defensive consolidation wave. No need to say that globalization is a new trend, and we will still see a lot of Asian countries acquiring assets in the US and North America. Having said that, we will not deviate from our mandate by still sticking to investing only in the countries where we have a deep understanding of the M&A takeover code, as well as in the countries where this takeover code is really binding.